You saw the thumbnail, you saw the title. You're seeing the articles on your screen. This is the issue Canadians and many Americans are currently facing. A mass population on the brink of bankruptcy is one of the most terrifying and painful things to see in the world. Today, I'm going to do my part in helping the North American population get out of this dire situation. Welcome to the first video in the Path to Prosperity series. The goal of this series is to help you with every aspect of your personal finances in a few simple videos. Further, while some of my videos can be quite complex and highly technical, these videos will use simple, logic-based examples and theory that everyone can easily follow and apply to their own lives to build their wealth. As many of you who have followed my channel for a while will know, I like to go above and beyond for our community here and on my videos. In this series, wherever possible, I will create some sort of tool to help you out with your journey in becoming financially independent and retiring early. For this video, I built an automated budget tool that will allow you to simply enter a few inputs and the model will take care of the rest of your budgeting up until your desired retirement date. Here's a quick sneak peek at what it does. The first tab gives you some simple instructions for how you should use the tool and gives you some context on what it can do for you. Simply insert your name on the second tab and then move on to the third tab. This third tab is where you will enter in all your financial information like your salary, your housing payments, your transportation payments, other necessary expenses, mandatory debt repayments, and your investment account balances and desired contributions. And then finally you decide what to do with your remaining discretionary income. The fourth tab is where all the magic happens. My model takes the information inputted in tab 3, then projects this information out until your desired retirement date. And then I'll cover tabs 5 and 6 later in the video when I show you in depth how to use the model. Tab 7 highlights what your asset and liabilities balance will look like when you ultimately retire and provides some sensitivity analysis and visuals to help you. This type of model is something many big wealth management firms would be willing to pay thousands of dollars for. So if you appreciate the amount of work I've put into the model, sharing this video with someone, especially someone who might be struggling with their finances, would mean the absolute world to me. Now that you've seen this video's party trick, drop a like to help with the algorithm and let's get started. So what is a budget and why is it important? Well, a budget is simply an estimate of your income and expenditures over a set time frame, usually until your retirement. However, the true value of having a budget is that it forces you to learn the core basics about personal finance, and the organization is really just a cherry on top. I'll start with explaining the important concepts related to your income or cash inflows. You need to think about 3 simple things here. First, what are the sources of your income? Second, what are the taxes and other deductions to this income? And third, how stable or reliable is this income source? When considering sources of income, most people will simply have their employment income here alone, which is completely fine. Other than my investment income, it's the only source of income I currently have as well. However, it's always a good idea to start thinking about how you can expand this. This could range from starting a small business, providing a good or service that you're passionate about, all the way to competing in semi-professional video game tournaments, which is something I did a few years ago. There are also some differences in how these different sources of income are taxed, which I will cover in the taxes part of this series. The other source of income you can create is investment income. Using leverage to create safe investment income is a strategy most of the richest people around the world use, which I will also be covering in detail later in this series. Taxes are one of the biggest expenses you will ever pay over your entire life, so it is imperative that you don't forget to deduct these from your gross earnings. There are other deductions like CPP and EI in Canada, for example, that you also need to account for. You also need to consider any expenses directly related to earning your investment income, like commissions that you pay to your broker or realtor fees, for example. Finally, you need to consider how safe and stable your cash flows are. It is extremely critical that you do this as it will have an impact on how large your emergency fund will need to be. I'll discuss what an emergency fund is and how you should use them shortly. So now that we've covered the income component of budgeting fairly thoroughly, we need to move on to your expenditures. Before we start going through some common expenditures and how to deal with them, I wanted to discuss some important wisdom a few legends of commerce have shared and help you ingrain their tips into your life seamlessly. First, Warren Buffett has said, "It's foolish to try to scale your income to your expenses. This is an easy way to run yourself into a mountain of debt." Second, Ben Franklin said, "The more you have, the more you will want. Instead of filling a vacuum, money makes one." Finally, my personal favorite, "Never spend your money before you have it." Thomas Jefferson. You can easily embed these first two tips or warnings into your budget using something called the pay yourself first method. The model that you'll be given access to uses this method to build your budget. Most people today end up receiving their paycheck and they go out and spend this money, and then they think about saving whatever is left afterwards, which often isn't enough. Unfortunately, this is what Ben Franklin was trying to warn us about. Even if you get a 20% raise to your income sources, if you live with a spend first and save second mentality, you're going to find a way to justify spending that extra 20%. The pay yourself first method essentially stops this vicious cycle by distributing your earnings in a different way. Under this method, when your paycheck comes in, you first cover your bare necessities, and then you put in as much as possible or desired into your retirement accounts to meet your goals and targets. Then whatever is left over, you can spend however you like. You can either reward yourself by buying something on your list of wants, invest some additional money, or you can make additional debt payments, which can be a good or bad idea depending on the type of debt you're paying down and your personal temperament, which I will also cover later in this video. You can avoid falling prey to the issue Thomas Jefferson discusses by capping your large expenditures on housing and transportation to a percent of your income. You can also limit yourself to using debt to purchase only appreciating assets or lower risk cash flowing investments like rental properties. Now that we understand how to avoid the big issues most people face when managing their money, we can begin looking at how you can best structure your cash outflows. The most important thing you need to ensure about your cash outflows is that they're going towards the most important parts of your life first. We'll start with the research-based guidelines for necessities. The general rule of thumb is that you should limit your overall expenditures on housing expenses to 25 to 30% of your pre-tax cash inflows. For renters, this means your rent, internet, utilities, etc. need to be captured within the 25 to 30%. For homeowners, this means your mortgage payments, property taxes, maintenance expenses, utilities, internet, etc. all need to be captured within that 25 to 30%. The general rule of thumb for transportation expenses is that you should limit your overall expenditure to a max of 15% of your pre-tax cash inflows. For car owners, this may include your insurance payments, any gas payments, maintenance fees, etc. For commuters, it's just your fees that are included. For your food expenses, there aren't really any strict guidelines that research seems to suggest. I think $390 per adult and $200 per child per month should be enough to get good quality and healthy food without overspending. Most online information suggested that you can spend a little less than this, but from my personal experience, I found that expecting a household to eat a fully home-cooked meal every day can be a bit unrealistic at times. The numbers I suggested give you some freedom to have some pre-packed food if you need a break from cooking on a specific day or something like that. Typically, the way most debt works is your loan is amortized, which is just a fancy way of saying paid down, using a fixed payment that is a mix of interest and principal payments. The proportion of interest versus principal is a function of your interest rate, the term of the loan, and the outstanding principal. A loan repayment calculator can compute your mandatory minimum payment for you, and I've also built this functionality into the model to keep track of any mandatory and additional debt payments you make. The model will automatically adjust how quickly you can pay off your debt as you make these payments. While these are the most common necessities you can face, there can be more, and the model will allow you to add such expenses. Remember, these expenses should be those that are essential for your survival and protection, such as any out-of-pocket medical expenses and insurance payments that you may have. As of right now, a sample cash waterfall would look like this. I used its $70,000 base salary for this waterfall example. However, see if you can spot the problem here. A percent of salary method can actually result in people adding extra wants as part of their necessities if their expenses are still below the suggested percent allocations. In the above example, if we assume the person lived in Mississauga, Ontario, Canada, they could probably find a comfortable place to live with all other housing expenses for about $1,200 a month. However, as Ben Franklin warned, the more money you are allocated to spend, the more you will. So while I think it's fine for someone making $70,000 a year to spend $1,600 per month on housing, I think they should be honest with themselves and accept that the $400 extra they're spending is actually a discretionary expense. There's a similar problem with transportation being a percent of pre-tax income as well. A Toyota Corolla will still get you to the same place as an Audi R8, for example. Again, as a luxury car owner, I'm not saying people shouldn't spend on the things they like. I'm just saying that people shouldn't classify extravagant purchasing decisions as necessities just because they have scaled their income above the median or average salary used by researchers to create these guidelines. Now we move on to the most important part of budgeting, planning for your future by paying yourself first. There are 4 main components that I want to highlight here. I discussed that understanding the risks associated with your income sources is incredibly important. An emergency fund is like an additional insurance policy on top of employment insurance that you can use to protect yourself and your family if you lose any income sources. The size of your emergency fund will depend on the riskiness of your income sources, which can be determined by assessing 3 factors. First, how likely is it that you could lose your job? A few things to think about here are the size of your company, your seniority at the firm, and whether your company is producing a good or service that is inelastic or essential to most people. Second, how quickly could you be rehired in a position making the same or better income? Some things to think about here are how in demand your skills are, the brand image of the company you're working for, and how much work experience and education you have. Third, you need to consider how volatile your income sources are. For example, a monthly salary is not very volatile. However, a realtor who earns money from commissions has a much more volatile income. The same can be said about dividends, for example, which can be cut during recessions. Based on the above factors, you should aim to hold either 3, 6, or 12 months worth of your income in your emergency fund, depending on whether your income sources are low, medium, or high risk. Further, your personal risk tolerance should also play a factor here. If you are a very risk-averse person, you may benefit from having a larger emergency fund than someone who is more comfortable with risk. Some of you may be thinking that this is what a line of credit is for. Unfortunately, line of credits are callable on demand, which means that if you do have an emergency and you need to withdraw and use the money, but the bank is also facing issues, they can recall the loan, forcing you to have to repay the amount right away. It's difficult to pay down a debt when you may have just lost your job or have fallen on some other financial hardship without having any other savings. The other issue with line of credits is that there is a lot more stress of having to go into debt when you are dealing with an emergency. However, there is also an added bonus of having an emergency fund that I believe is often overlooked. Essentially, if you have this cash lying around preparing for an emergency and a recession hits, but you don't lose your job and there's little risk that you will, you can use a mix of a home equity line of credit and your emergency fund to take advantage of some mispriced equities that have been unjustly oversold or some cheap housing that arises. There are 2 major retirement accounts in Canada, and the TFSA is one of them. The contribution limit for this account is currently $6,000 a year. I'll cover the different retirement accounts and best practices when using them in detail later this series. For now, I'll simply say that if you expect your income to be higher than it currently is for an extended period of time in the future, then you should contribute as much as possible to your TFSA now rather than your RRSP. This is due to tax reasons, and there are a few exceptions to this rule that I'll discuss next. To my American viewers who are watching, our Canadian TFSA is most closely similar to your Roth IRA, and our RRSP is most closely similar to your traditional IRA. The other major retirement account in Canada is the RRSP. The contribution limit for 2020 is 18% of your earned income reported in the previous year to a maximum of $27,230. One of the exceptions of when it's almost always a good idea to contribute to your RRSP is if your employer has a group RRSP program with competitive matching. For example, if your employer offers to match 100% of your contributions up to 5% of your salary, that's an amazing deal. Essentially, it means that you get a 100% return the moment you contribute some money into your group RRSP. There is nowhere in the stock market that you can earn a 100% return on a monthly basis risk-free. For group RRSPs, there is only one other thing to consider. These plans often only have access to a limited amount of investment vehicles with higher MERs, which are expense ratios. There are also restrictions on how often you can withdraw your money, and if you do withdraw money, there can be penalties stopping you from being able to contribute to the plan for a while. For your personal RRSP, the story is the opposite of the TFSA. You want to be contributing to this account when you are at the highest income level you expect to achieve over your career. This is because you get a tax deduction when you contribute to an RRSP, which reduces the amount of income you are charged tax on. There are other times when it's important to deposit money into your RRSP account, but I will cover this in detail in a video I make that summarizes how best to use these retirement accounts to your benefit. So I continued the waterfall example based on the above information. In this example, after contributing to their investment accounts, the individual is left with $171 per month to spend on any discretionary expenses they like. However, if they spent only what was a necessity for a comfortable living on housing and transportation, then they would probably have closer to $1,000 a month to spend on their discretionary expenses. Next, I'll discuss the things you can do with the remainder of your money after paying yourself first, which will be listed in order of what may be best for you in the long term. First, if you have any high interest debt outstanding, it is most definitely a good idea to repay this first with your excess cash flow. Similar to group RRSPs, if you repay a credit card with an APR or interest rate of 20%, you have just outperformed the S&P 500's average return instantly by not having to pay this interest on the principal repaid. This trade-off becomes less clear when you have debt outstanding at lower rates. I'll discuss certain situations when it's best to pay off your debt as soon as possible or when it's best to keep it for as long as possible in an in-depth video about all the types of debt and how to use them to your advantage later in this series. My general rule of thumb is that if the debt is variable and has an interest rate above 4%, I try to pay it down as fast as possible. However, if the debt is a fixed interest rate with the rate below 4%, I employ a mixed repayment and investment strategy with my excess cash. Any extra repayment on debt on top of your minimum payment is fully put toward your principal balance of the debt, which can be extremely powerful. For example, if we put an extra $170 per month towards a debt of $35,000 at 4.45%, with minimum monthly payments of $367 per month, we can reduce the overall payment time from 10 to 6.33 years, and it saves over $1,000 in interest expense. Unfortunately, people are very bad planners, and this often results in people defaulting to use debt to make big purchases of gifts or rewards for themselves or the people they love. This is an awful thing to do with your money in most cases because it substantially increases the cost of whatever you're buying due to the interest cost over time. Further, most discretionary purchases depreciate or go down in value, so buying them with debt means you're paying even more for something than retail and its value is going down over time. A sinking fund is likely what Thomas Jefferson envisioned when he mentioned that you shouldn't spend money before you have it. What's even better about a sinking fund is that if you use a high interest savings account as you're saving towards your goal, your money is working for you and bringing you closer toward your goal. third, there's nothing worse than doing everything right for years, saving, and now being ready to enjoy the fruits of your labor, but then being unable to because your health has degraded past a point where you can enjoy the things you used to like. So definitely take some money out of your leftover discretionary expenses to focus on improving your health and well-being, as it's very important. Fourth, while this is technically the least important thing you can do with your money, it's actually the most fun thing you can do with your money. This is what your hard work is all about, having this freedom to do what you wish with your money without feeling guilty for treating yourself. My personal things to save for or spend on are supercars, watches, and going out with friends. I'd love to hear what your favorite things are down in the comments below. So I was originally going to walk you guys through how to use the model in this video, but it's already gotten a bit too long. So I'll split this video into 2 parts, and I'll leave the link to the other video in this description and up there to the right once it's been uploaded. If you enjoyed the video, please drop a like, share the video with a friend, subscribe with notifications on, and leave your thoughts down below in the comment section. As always, remember to be eager to learn, willing to invest, and prepare yourself for success.